Hey, this is Morgan Smith, partner and advisor with WorthPoint. I'm a certified financial planner, and I've got a special guest today, Nate DeLong. Nate, how you doing?
I'm doing well, Morgan. Thank you.
Good. Well, today we're going to talk about the benefits of integrating a cash balance plan or profit sharing plan with a cash balance plan. There's a couple ways you can design and implement cash balance plans, and there's definitely some benefits to including a profit share with that. And so we'll run through that today. Thanks for joining us. And my special guest today, again, is Nate DeLong. He's a certified pension consultant and vice president with Future Plan, and he can be reached at nate.delong@futureplan.com. All right, so the goal of this video is to clarify why integrating a profit sharing plan with a cash balance plan can be beneficial for business owners and overall plan design. So first off, let's talk a little bit about what a profit sharing plan is. Again, the whole idea here is we realize the business owner realizes they want a pension plan or a cash balance plan, and what can they do to maybe add some benefits to that? And we're looking at a profit sharing plan. So let's make sure everyone understands what a profit sharing plan is. We're going to review profit sharing plan scenarios and look at how things look once you integrate a profit sharing plan with a cash balance plan. Look at a hypothetical case study and contrast to compare a cash balance plan without a profit sharing plan and then a cash balance plan integrated with a profit sharing plan. So first, the profit share plan. Just as a reminder, profit sharing plan accepts discretionary employer contribution. So I think two key terms there: discretionary. Any given year, the employer may or may not contribute based on how the cash flow is looking, really, and their employer contributions only. There's no set amount that the law requires you to contribute. If you can afford to make some of the amount of the contributions to the plan for a particular year, you can do it. Other years, you don't need to make the contributions. So, and I think a misnomer, it's called a profit sharing plan, but your business doesn't need to make profits to make contributions. And again, these are tax, above the line contributions to a profit sharing plan that would benefit the tax situation of a business owner potentially. Obviously, talk with your CPA about all of that good stuff. If you do make contributions to the profit share plan, you will need to have a set formula for determining how the contributions are divided. And in that case, you need an actuary, a TPA, and that's something Nate has resources for as well. If you establish a profit sharing plan, you can have other retirement plans. So you can integrate it with, say, a 401k. In this case, we're talking about integrating it with a cash balance plan. You can be a business of any size. You need to annually file a Form 5500. And again, they're employer contributions. So it's not like a 401k plan where you've got a employee deferral. But again, you can also integrate these profit share plans with a 401k if you needed to, and you could have both. Contribution limits for 2024. It's the lesser of 100% of compensation or $69,000. So that's a quick overview of what a profit sharing plan is. Nate, anything to add there?
No, it looks good. I think you
Okay.
you hit all the key points.
So let's look at the possible combinations of what you can do with a profit sharing plan. So again, you can just have a standalone profit sharing plan if that's what you want. You can integrate a profit sharing plan and a 401k, and this is something Nate and I see out there with business owners pretty frequently. You can integrate a cash balance plan with a profit sharing plan. This is the actual scenario that we're going to look at and just going to compare and contrast a cash balance plan only with an integrated plan. And you can also integrate all three: a profit sharing plan, a 401k plan, and a cash balance plan together. There's also some benefits in integrating everything together as well. But we're going to look at this combination here. I just want to let you know with a profit sharing plan, it's something that can sit out there standalone, or you can integrate it with other plans. All right. So what we're going to do now is we're going to look at a hypothetical scenario here. And I'm going to turn over to Nate to talk about this hypothetical cash balance plan and comparing it to a standalone cash balance plan. So you just go out there and implement a cash balance plan, and some benefits you might receive as a business owner if you actually integrate the cash balance plan with a profit share. So Nate, over to you.
All right. Thank you, Morgan. So oftentimes we're asked to prepare some illustrations to show a business owner what's possible inside of a integrated type retirement plan. And the first step is to usually request a census file. We need to know who the owners are, who the employees are, age, income, how much they make on an annual basis. So as we look at this completed census file and illustration we prepared, we'll first look at the 4 owners. We've got their individual ages and their annualized compensation. We've got approximately 30 staff members. However, only 16 are eligible to participate based on the eligibility requirements we set forth with the business owner. And as we look at this, we've got profit sharing cash balance. And then we also on the far right have a standalone cash balance plan. So when we look at the total allowable contribution amount for the business owners in the standalone cash balance plan, it's approximately $897,000. So very significant contribution amount. And as you'll see in that green column for business owner number 1, they're deferring in excess or contributing in excess of $300,000, approximately $325,000. That $325,000 is their maximum allowable contribution based on their age and their income. But as you can see, it's 0 to $325,000. So there is some flexibility in there for a business owner to say, hey, $325,000 is a little bit too much. They can pick any number less than $325,000 for business owner 1 as their targeted contribution, or they can decide to do 0 if they don't want to participate. So they've got a lot of flexibility on how they set this up. But what's key, I believe, is the required contribution to the staff. These are ERISA plans, so they do need to pass non-discrimination testing. So for the business owners to put away $897,000, the employees need to receive approximately $240,000 in total contribution, or approximately 22% of pay in order to pass the testing. So a pretty significant contribution amount for the business owners, but does require a contribution to the staff. In this case, about 22% of pay based on the census file.
So cash balance plan standalone, there's a benefit and a cost. And in this case, the benefit is the business owners get to put away $897,000 if they maximize their contribution. And that's all pre-tax. So Nate, you don't get taxed on that as a business and an owner. But the cost of that is really the 22% of pay, or $240,000. And that's, again, for a standalone. So now, why don't you walk us through, let's say you've got a cash balance plan, you go, okay, well, let's just add a profit sharing to that and look at the difference in these numbers and the benefits you would get by adding a cash balance plan.
Yeah, I'm putting away $897,000, sheltering that money, those profits from current taxation, and taking a dollar for dollar tax deduction for the business is very attractive. What's a tough hill to climb is the 22% of pay to the staff. So a lot of times what we'll do in these situations is we'll add the profit sharing plan. And that's in the yellow column there. And what you can see is adding the profit share with the cash balance actually delivers a larger contribution amount for the business owners. $1,041,000 total contribution for the business owners. So an increase in the amount they can contribute and still pass the testing. But I think what's most appealing here in these types of designs is when you add a profit sharing plan, it allows us to use a different set of numbers to calculate the required employee contribution. So in the standalone cash balance, it's 22% of pay to the employees to pass the testing. With the profit sharing added to the cash balance, we can use a higher interest rate assumption, and it allows us to reduce the required contribution to the staff from 22% of pay down to 7.5% of pay. So a little more than a third of the required contribution that a cash balance would require can be delivered in the profit sharing plan and still pass the testing. So when we add the profit share with the cash balance, we increase the owner contribution to $1,041,000, and we reduce the required contribution to the staff from $240,000 to $85,900. A reduction of $154,000 in required contribution to the staff. So that's usually a much better outcome for the business owners contribution-wise. And then the fact we have to fund the staff, greatly reduces the required cost to implement the cash balance plan.
Well, I mean, if I'm looking at that as a business owner and I'm looking at the cost to me, and the added benefit I could get, I'd be hard pressed to not integrate a profit share. Let me ask you this, Nate. If I'm a business owner, I've got a cash balance plan in place right now, but I didn't have a profit sharing integrated with that. Can you tack on a profit share after the fact, or how does that work?
You can tack on a profit sharing plan after the fact. And a lot of times we can amend out some of those features and potentially reduce that required contribution. And again, that 7.5% is the minimum to pass the IRS testing. 22% is the required in the standalone cash balance. But if a business owner feels that they want to contribute more than the 7.5% for the staff, they're definitely able to do so. But the 7.5% would be the required minimum.
Got it. And to do that, we'd want to get a census from the business owner and kind of do a reanalysis on that, and a couple weeks to figure that out and present it to the client. Now, could they implement that in the middle of the year, or would they have to wait to the end of their financial year?
They can implement that in the middle of the year. And in fact, if there are a couple of employees on that census file that they really like, that are really valuable to the business, you can give most of the employees 7.5%. But if there's a couple of employees that are really valuable to the business, you can actually add an additional contribution to them. So maybe 10% for these 3 or 4 employees that are really valuable to us. Everybody else gets 7.5%, and then the business owners receive the maximum contribution.
Gotcha. Well, I think this is very enlightening. I think it shows the power of experience and expertise in figuring out the best solutions for business owners. Some people might have looked at a cash balance plan and not even thought of putting in a profit share. The magnitude of some of the benefits there are pretty impressive. And the fact that, you may have a cash balance plan and go, think, God, I'm not doing as well as I could have. And I'd like to, reduce some of my kind of overall costs and things like that. It's something you can look at and add as well. So Nate DeLong, certified pension consultant and vice president with Future Plan. Thank you so much. And last thing I just want to end this up with is I just want to explain our roles here when we work with cash balance plan. I'm a financial advisor. And you can see in some of the other videos that we did that cash balance plan kind of have a unique investment strategy that you have to look at, and it's a little different from other investment strategies. With your firm, Nate, Future Plan, and your role in that, what do you focus on?
Well, we really focus on helping the business owner meet their goals and designing a qualified retirement plan that's going to accomplish their goals, whether it's increased tax deductions, sheltering profits, accelerated retirement savings, attracting and retaining employees with the use of a qualified retirement plan. So we help initially with the plan design and then prepare the legal documents. And then on an annual basis, we help with all the calculations and then preparing the tax forms. Both of these plans need to file a tax return, and we prepare those forms signature ready for the business owners to review with their CPAs.
Great. Well, thanks again, everybody. I hope you found this helpful for you. If you need to contact either of us, just go to the beginning of the video and we've got all our contact there. Nate, very much appreciated. And maybe we'll see you on another video here. You have a great day, and thanks for your support.
Yep. Always a pleasure, Morgan. Thank you. Take care.